find those stocks that outperform the market. Don't just buy an ETF and get the average of the market. So there might be opportunities there. But our concern is that those headline numbers, there's something else behind them. And a lot of people are assuming that all of a sudden in 2014, you hear a lot of people and a lot of economists saying, it'll be easier next year. We're going to grow at 3.5%. Why? There's not really a good reason. Oftentimes Bernanke will say, there's going to be less resistance from fiscal policy. That sequester, we're not going to have that. Well, yeah, we'll have that. It doesn't go away, it's just that we supposedly addressed it. And actually, we didn't address it. When you look at what Washington has done, they didn't make cuts. They postponed maintenance. Well, now you got to postpone maintenance again next year. And the other thing they did was allow people to take furlough or vacation. That would be unpaid vacation. What kind of vacation is that? How much can we go out to dinner? No, we're on vacation, we're not getting paid. How happy a vacation is this? So oftentimes it was 15 days vacation. Well, by the way, they didn't do this for $85 billion. There aren't real cuts. The amount was really more like $45 billion because it started only at the end of March and goes to the beginning of October. 85 is the annualized number. So if the solution happens to be postponing maintenance, now you got to postpone more maintenance, not just the same, but more to have a longer annual impact. And by the way, the people that took 15 days off, next year, they're going to have to take 25 days off without pay in order to meet that 85. And that doesn't even begin to address sequestration 2, which means at the beginning of the next fiscal year for the government, October 1st, not too far off, there's another $109 billion in cuts that have to be made, and nobody seems to be focused on that. So to us, that's a hurdle for growth. And if you're planning on a magical appearance of 3.5% growth when you only get 2 to 2.5 this year, we think that this is a hurdle that you're going to have to overcome in order to grow that fast. The other hurdle is that all the jobs that we're seeing being created, they aren't very good jobs. I say that because when we look at, there's a regular federal jobs number and then there's a household number, and when we look at the household number, we find that of the jobs created so far this year, 65% are part-time. That's not a job, it's half a job. Maybe it's even less than half a job, but it's not a full job. Why are we counting 65% of the jobs as full jobs? It's no wonder that a lot of economists at the beginning of the year were saying, hey, look, first quarter, how did we only end up with like 1.5 or less than 2% growth? We had like almost 200,000 jobs a month. We should have better growth than that. Well, they weren't real jobs, they were only partial jobs. Add to that the fact that in the last 3 months, 30% of the jobs that were created are in leisure and hospitality. Leisure and hospitality, on average, make $310 a week. That's not a whole lot of money. And by the way, that's less than half the average of all other jobs. So maybe some of those are part-time jobs. Maybe that's why they pay so less. And maybe there's a little double counting of this 65% and then 30% now in low-paying jobs. But the bottom line is, of these jobs that are being created, by the way, it was 190 the first 5 months, the last 3, 148. So we're not creating as many jobs and they're still not very high quality. Not surprising that our concern is that we're not having a base of people with a lot of money coming in because they have new jobs that they can go out and spend and create economic growth at a higher level next year than what we have this year. We think we're going to get much the same level of growth, 2 to 2.5%. And then finally, the other thing that's developed since May, higher interest rates. Well, when the Fed wants to slow down the economy, what do? They raise interest rates. Well, they didn't raise them, but the rates are higher. And so now, if you've got mortgages now at 4 3/4 in the 30-year area for a 30-year mortgage, a lot of applications for housing are slowing down. We get a week-to-week number. This morning we got a number down 13.5%. If we looked at year-over-year comparison, we have more than 15% fewer applicants for purchasing homes this year than what we had last year. So those mortgage applications are down, and it just happened in the last couple of months because rates went higher. The other thing that's happened is at the beginning of the year, we had a lot of people refinancing. I was one of them. There are a lot of people out there refinancing, taking advantage of lower rates. What's that do? It means that you pay less because you're paying lower interest rate, It gives you more money to put in your pockets. Like good Americans, it doesn't stay there long. We go out and spend it. My wife goes out and spends it. Actually, I spend some of it too, so I don't want to be sexist here. But we go out and spend it, and that helps out the economy. That creates some jobs. That's gone. Right? How many people can refinance now with interest rates over a percent higher, closer to 1.5% higher? If they could refinance, they already did it. So that benefit to the economy won't be enjoyed by us next year. So it's another reason. And I'm not trying to create a situation where, hey, we're going to go into depression again. Yes. I'm only trying to say that the expectation for an automatic increase in growth and a great stock market might not unfold the way we hope it would. That instead we're likely to have a market and an economy similar to what we have right now. We'll chug along at 2 to 2.5%, and that will allow opportunities to find good opportunities in the stock market. And even if you don't find good opportunities, you'll still have positive returns. But when all is said and done, it's not going to be a 20% a year, a 15 to 20% a year. It seems hard to accomplish that as an expected rate of return in the stock market. So still buy stocks, still stay away from high quality. But the other thing that this 2 and 2.5% does, if we're just going to chug along at that rate, it's still a good environment for other kinds of bonds, corporate bonds. Some even high yield, or they're called junk. And everybody knows they're called junk for a reason, right? But lower quality bonds. And if you're growing at 2 to 2.5%, that might not be enough for you to get really excited about the company because maybe it doesn't increase profits enough. So maybe you don't want to buy the stock, but that's plenty of growth. In fact, you don't need any growth for them to continue to be able to pay their debt, pay their interest rate if you own their bond, and pay off the debt whenever it matures. So the hurdle or the requirement necessary for economic growth for you to be comfortable with owning debt rather than the stock might be a little bit lower. You don't want us to go down to zero or negative because then people will be fearful that these companies are not going to do well at all. But as long as that's not your forecast or our forecast, it seems that lower quality corporate bonds might be an opportunity for you to investigate. Now, it's not everybody's cup of tea. A lot of people don't like to take on credit risk, and it's very understandable. So I hesitate to say, you got to put a lot of money in here. I've got a lot of money in there, but it may not be everybody's cup of tea. And really the right person to talk to is Greg and his team because they know your willingness to take on risk. They know what else is in your portfolio. And if you've got a lot of equities, then you probably don't want to double up and buy below investment grade bonds too, because they're both going to react to a stronger economy and not react well to a weaker economy. So you have too much risk. But it is a consideration. And it's not something that's going to improve in price, but you're likely to get a pretty decent income stream. And whether it's bank loans to these companies and you get 4%, or straight debt to these companies and you get 6%, no, that's not going to be a bad return if your baseline forecast for an average stock market is 6 to 8%. So those are some of the things that we would suggest that people think about whenever they design their portfolios. Those are some of the discussions we have with professionals like Greg and Frank and the rest of his team. And those are some of the things that we try to incorporate whenever we manage portfolios. And whether we're managing portfolios on behalf of you or our mutual funds, those are some of the considerations that we try to take or keep in mind over the next year. And it sounds like, in one sense, a pretty bleak forecast. We think it's rather realistic. We just would caution people to manage their expectations because so many people, and it may not be people in this room, but so many people in the aggregate had stayed out of the market last year, the stock market, and the year before. And only now they're putting their money in. And we've had a great market so far this year. If the expectation is you're going to get that all over again next year, we just caution you a little bit. So with that, we can open it up for questions. We can take the conversation where you want to take it and maybe discuss what's important to you and maybe some of your concerns. So we can go anywhere you want in terms of topics, even if you don't want to talk about investments yet.
Questions on anything about interest rates, the economy, stock market, bond market? We have the guru in the room, so.
Oh, great. Munis. What about munis? I talked about mostly taxable, but munis actually offer better value right now than taxable securities. And that's because we've had, one, people are really fearful of what's happened. They've seen some losses and they say, uh-oh, if this is the beginning of the end, I'm getting out of here. They've seen Detroit and they thought, uh-oh, no, maybe what's her name was right. Maybe we are going to get tons of defaults. I better get out of munis. And then they saw the cover of Barron's 2 weeks ago and they said, oh, munis are just the worst place you could possibly be. Well, the fundamentals of munis haven't really changed all that much. We've had 13 consecutive quarters of really increases in revenues. They've had higher sales tax revenues. They've had higher income tax revenues. So they're much better off than they were several years ago, and they continue to improve. We actually, as managers of municipals, would prefer revenue bonds as opposed to general obligations. And a lot of other people say, oh, you should just go with the general obligation. They can increase taxes whenever they want. Well, a long time ago, California taught us that's not the case. No, because California said, no, you can't raise our taxes again. And a lot of other people have revolted and said, no, you can't raise our taxes again. So the assumption that you automatically have this, unending revenue stream that you can increase at any time, is now subject to votes. And so we'd rather look at, a bridge or a tunnel or a water and sewer bond and look at, okay, how much revenue do we get? What kind of usage rates do we have? How many people or how many cars are going through that bridge, through the tunnel or over the bridge? And we can pretty much count on what the revenue stream is going to be. And if the economy slows, we can kind of stress test it and say, okay, if things get as bad as they were in 2008, now what do you have? Do you still have enough money that it's going to pay off our bonds? So our analysts, go through these kinds of machinations to try and figure out, okay, where do we find value in municipals? And generally, it's easier for us to identify a reliable revenue stream on revenue bonds than it is on general obligation bonds. So in portfolios that we manage, we kind of prefer that. Again, we would not want to go out 30 years. Now there's a very steep curve, meaning that the longer you go out, you don't need to go out 20 years, because 20 years actually yields more than 30 years. But if you go out 20 years, boy, you can get 5% all over again. It's been great to get 5% on your municipal bond, and that's a long-term kind of benchmark out there. And if you want to buy it and hold it and close your eyes and say, okay, I know it might be volatile, and enjoy that income stream, that's not a bad thing to do. But we think you're better off, as we talked about at the beginning, being more today in intermediates and maybe short-term, and maybe you don't quite capture the 5%, but there is risk out there that whether it's Larry Summers or this gradual normalization of rates, that you could see rates rise a little bit more, and that would cause some damage to longer-term municipal bonds. Now, we don't think the credits themselves are really that much at risk. Certainly we haven't owned, nor would we want to own Detroit or San Bernardino or Harrisburg, the trash bonds, appropriately named. But good analysis keeps you away from those kinds of securities. We would want to own things largely in, the 7 to 10 year area is a good area. If that's too much risk, then maybe a little bit shorter than that. But there have been so many people selling those bonds that they're now much cheaper even than what we see in the taxable market. And we are close to a point right now where people who can't even benefit from the tax preferred nature of municipals are going to start buying. And I say that because we look out there and we see single A rated municipals at a higher yield than single A rated corporates. Well, that doesn't make any sense. This is tax-free to somebody like yourself. So there's a great opportunity out there. And when we've seen this in the past, we've seen hedge funds come in and they say, hey, this isn't going to last. Somebody's going to come in, eventually buy this. They're just, they've got their head in the sand, or they're just hiding under the pillow right now. In the next 6 months, it's going to turn around and they go out and buy these securities. Sometimes you find funds, and we've done this whenever the rate is high enough in the municipal market where our total return, taxable market or taxable fund, goes out and buys it. And you might find institutions. We manage money for institutions as well, like Boeing and New York State teachers and firemen. And on their behalf, we can justify now buying a municipal because it actually yields more without any consideration for the tax-free nature of it than the taxable market. And so we're on the brink, we think, over the next month or so, of more people coming in and maybe starting to bid up those securities. So it's really, we've seen an overreaction to municipals. We still wouldn't necessarily say, hey, go out and take advantage of the really cheap stuff in the long end. We think there may be more volatility between now and several years from now, but being in intermediates, capturing some pretty extraordinary yields, especially on a tax adjusted basis, really makes an awful lot of sense. So we really like the municipal market right now and recognize that it's not the municipal market you used to have, you know, where there were 70% of the market or more several years ago. It was all in AAA securities. Remember AAA insured bonds? And we thought the insurance was really worth something. Well, now less than 10% of new issues are AAAs, but that's okay, because if you go with, you know, an asset manager or somebody that Greg identifies really has a good history of evaluating credits, you're much better off buying something not a AAA or a AA, but even a single A, because the opportunity for distress in a single A is one, pretty remote, and if you have professional managers evaluating those credits and making sure that there isn't a credit problem there, and you're likely to, you know, to have a distressed credit, then you'll capture more yield. So those are some of the things that, you know, professional managers might get done in the municipal market, areas that we think offer a fair amount of value, and maybe a reason why, because of how cheap they are now relative to even the taxable market, where there might be an opportunity for improvement, at least short-term improvement, over the next couple of months. Longer term, I think, again, even the long end might suffer a little bit of an increase from these levels. It won't be the same level of increase that we see in the taxable market, because they've already given up a lot of ground, but there could be some additional volatility in the longer end. I wouldn't suggest you go out there unless you just say, okay, I like 5%, I can deal with volatility. Yes, sir.
Zane, could you comment a couple words about the wisdom of purchasing high-yield bond versus a high-yield bond fund?
The wisdom of purchasing high-yield bonds versus a high-yield bond fund. I've been in this business for too many years. I mean, we're talking in the 30s, so I've been around for, not that I started in the 30s, but 35 years plus. And I would never buy high-yield bonds. It's just, high-yield bonds are, one, really risky. There's an awful lot of analysis that has to be done. These companies lie to you, and you have to understand who's lying and who's not, and you have to test that with their vendors, you have to test that with their competition. You know, there are a lot of unsavory characters in the high-yield market still today, and I would always go with a fund, ours or somebody else's, because you need diversification. And if you buy your own bonds and you have time to do the analysis and you like doing that stuff and interviewing people, and you can get an audience with the CFO or the president and they come to visit you like they come to visit us, that's all great. That's very time consuming. And even in that environment, if you end up with 10 bonds, that's not enough. One of those bonds goes into distress, you've now lost, you know, half of that or 5% of your portfolio. That's going to be hard to capture back again. So I would always go with a bond fund of sorts. It gives me a lot more diversification. It gives me an opportunity for people to make sure that they've analyzed that bond. And I have a not only sector diversification, but, you know, complete individual security diversification and maturity diversification as well. So I'd always go with a bond fund rather than buying them myself, because one, I'm probably not a very good analyst, but even if I was a professional analyst, I'm not sure I would go down that road. There's just really too much risk.
Just two comments. First, I want to address, because I know for most of you, we've used individual bonds, and Zane's point is these high yield, that's almost like managing equities. So there's a lot of value.
Good point, yeah.
There's a lot of value that professional management lends itself to with a high yield bond as opposed to a high quality bond. And just something we're observing in the muni space, I just wanted to answer on the other question, was supply and demand. A year ago in this room, we did a presentation on the new tax laws. And we thought that the income tax rates were going to go up. We thought that the capital gain rates were going to be going up. And in fact, they did. So on an after-tax basis, if you're getting a 3% yield on your munis, and you were in a 35% marginal bracket, so let's call that 4. Well, now your 35% bracket, 39.6, now that after tax return more like 4.5%. That reality has set in among your peers, among higher income investors. So we've seen a real disparity with regards to demand of high quality munis, and that's been very supportive of prices. We think that trend's going to continue. We routinely see institutional managers taking a while to actually get the client's accounts invested because it's hard to find paper out there. So for people who are in a high tax bracket, the after-tax return on munis is better this year than it was last year.
Yeah, I think that idea of supply, there used to be a lot of inventory where you could go out and there were a lot of firms on Wall Street that had tons of municipal bonds, and now for a variety of reasons, they don't have them. Some of the firms have just left the business completely. Others, you've heard of Dodd-Frank and the Volcker Rule. And the Volcker Rule says, hey, you really can't trade for your own account. You can't trade proprietary money, and therefore they've decided we're not going to hold as many municipal bonds. If we can't buy and sell them, and all we can do is execute on your behalf, then we're not going to hold a lot of inventory. So as a result, it's much more difficult to find inventory. We are blessed with having managed, I should do this well, we are blessed with having managed municipals for a long time. And the street knows how we manage municipals. And so when they get inventory, or when they get somebody who's selling a portfolio, they know, okay, this is something the Lord Abbett wants. No, let's give Lord Abbett a call. This fits what they traditionally buy. We know they like this credit. We know they don't like this credit, but at least show them this stuff and see if they're interested. So we really get first look frequently. And I'm sorry, I didn't mean to do a commercial. I was just trying to reinforce your points. I'm sorry. But we did do a good job. Another question? Nope. All right. Well, thank you very much.
Zane,
Thank you
here
for
for
the
a few more
opportunity.
minutes. And please feel welcome to have some dessert and coffee. And how about a round of applause for Zane?
Ah.